In this video, I would like to highlight the characteristics of balanced funds. So balanced funds, also known as hybrid funds, are a type of mutual funds that invest in a mix of asset classes, typically a combination of stocks, of bonds, and sometimes other assets like real estate or commodities. And the main goal is to provide both growth and income, balancing risk and returns. And so here are some key characteristics of uh, of of a typical balanced fund. Number one is diversified asset allocation. Diversified asset allocation. So balanced fund, invest in both equities, that is stocks, and as well as fixed income, which is bonds, offering broad diversification. The typical allocation might range from what is called 40-60. That's you know uh, 40 in stocks, and the rest could be in bonds. Although this can vary depending on the specific funds. There's no hard and fast rule about how to go, about this allocation, depending on the discretion of the fund managers. So usually you have the bond part of the fund, and you have the stock part of the fund, and you might even incorporate, other asset classes like real estate and even like commodities could be incorporated into the fund. Number two is moderate risk. Moderate risk. Since they invest in both equities and bonds, the balanced funds aim to provide a balance between growth, that is stocks, and stability, which is bonds. So stock provides growth, and bonds provide stability. So they tend to be less volatile than pure equity funds, but carry more risk than pure bond funds. They're just in between pure equity fund, and pure bond fund. It's a kind of hybrid. They are right in between, and they carry, lower risk than equity, but more risk than pure bond fund. Number three is income generation. Income generation. When it comes to generating income, balanced funds typically pay dividends from interest income on bonds and dividends from stocks, making them a good option for investors seeking both capital appreciation and regular income. So when the bond coupons come in, you partake. When dividend from stocks come in, you partake. So you have that particular, appreciation as well as regular income. I think that's very interesting. Number four is a long-term investment focus. That particular long-time horizon when it comes to investing in a balanced fund. And these funds are generally designed for long-term investors who want to avoid extreme volatility of a pure stock investment. And not only that, you want to, aim for a higher return than what is obtainable in traditional bonds. All right, you want to avoid the volatility of stocks, and you also want to avoid, the lower. You want to equally avoid, lower returns from a traditional bond fund. Number five is automatic rebalancing. Automatic rebalancing. The rebalancing can be placed on auto mode. So many balanced funds, automatically adjust the allocation between stocks and bonds to maintain a consistent risk profile. They have a risk profile, and they keep on adjusting the ratios of stock to bond, percentage, of bond to stocks, so as to be able to maintain, that lower level of risk, that acceptable level of risk. For instance, in a market as market fluctuates, actually the fund manager may adjust the portfolio to keep the mix, within a specified range. Usually, the ratio is determined by the nature of the markets. So the manager keeps on adjusting to be able to maintain, you know, the entire portfolio at an acceptable level of risk and returns to give a balanced kind of risk return ratio. Number 6 is targeted at moderate investors. Balanced funds are suitable for moderate risk investors who are looking for a more conservative approach compared to all stock funds, but still want some exposure to higher return than the stock market offers. People have different risk tolerance. You have moderate, you have conservative, you have high risk, and you have no risk. People want to keep their money in cash. But even at that, it's still risky because inflation can eat into cash. Please subscribe to this channel and like this video and drop a comment in the comment section so I can I be able to determine how to serve you better. Your subscription really counts. Number 7 is active or passive management. Active or passive management. Some balanced funds are actively managed, meaning a fund manager makes decisions about asset allocation when it relates to a stock bond selection. Others are passively managed, often following a specific index or predetermined allocation strategy. Some are actively managed, some are passively managed. For those that are passively managed, they simply buy an index fund. They simply invest in the index, and that is all. Each of these approaches each of these approach has its pros and cons. Number 8 is expense ratio. So balanced funds typically have a moderate expense ratio. An actively managed balanced fund may have higher fees than passively managed funds. That is the facts for actively managed funds. The activity itself, will attract a higher fee. They may not really guarantee higher returns, but it attracts higher fee because generally speaking, passively managed funds tend to do better than actively managed funds. So active fund managers hardly beat their benchmark over an elongated period. They don't do that consistently. Number 9 is capital appreciation and income. Capital appreciation and income. The dual objective of balanced funds are to generate capital appreciation through stocks as well as provide income through bonds, offering a relatively stable investment option for with growth potentials. There's growth in the stock aspect of the portfolio. There's regular returns in the bond section of the portfolio. So it is a very good proposition. Number 10 is a suitability for retirees and conservative investors. It is suitable for those who are retired and those who are conservative. They cannot stomach risk. And so due to their income-producing nature and moderate risk profile, balanced funds are often used by retirees or conservative investors who seek a steady income. They have that desire for steady income stream, while same time maintaining some growth potentials in their portfolio. They want steady income. They equally want, to be able to obtain a level of growth in their portfolio. Then balanced fund is a very, very it's a viable alternative. So these characteristics make balanced funds, an attractive option for investors looking to achieve a balance between risk and returns, while without having to actively manage a diversified portfolio themselves. You just buy the fund. The fund has the fund in its structure is invested in diverse kind of securities. So the fund itself is diversified, it's balanced. It's a very, very good proposition for investors.